The PE ratio is one of the most popular tools in the stock market, but also one of the most misunderstood. Let's simplify it. PE stands for price to earnings ratio. It tells you how much investors are willing to pay for every RS1 of a company's earnings. In simple terms, if a stock has a PE of 20, it means investors are paying rupees 20 for every rupees 1 the company earns. Now the big question, is a high PE good or bad? Let's understand with Indian examples. Take Reliance Industries. It usually trades at a moderate PE because it has stable earnings across sectors like telecom, retail, and energy. Investors trust its long-term growth, so they're willing to pay a premium, but not excessively high. Now compare that with Infosys. IT companies often have higher PEs because of consistent profits and global demand. When earnings visibility is strong, investors are ready to pay more. But here's where it gets interesting. Look at a high-growth stock like Tata Elxsi. This stock has traded at very high PE levels in the past. Why? Because investors expect rapid future growth. They are not just paying for current earnings, they're paying for future potential. Now flip the scenario. A company with a low PE might look cheap, but it can be a trap. For example, if earnings are falling or the business outlook is weak, the stock may deserve a low valuation. That's why PE should never be used alone. Here's how smart investors use it. First, compare within the same sector. Comparing a bank with an IT company makes no sense. Their business models are different. Second, check the growth rate. A high PE stock with strong earnings growth can still be attractive. Third, look at historical PE. If a stock is trading above its usual range, it might be overvalued or pricing in future growth. And finally, combine PE with other metrics like ROE and debt levels. So what's the takeaway? PE ratio is not just a number, it's a reflection of expectations. A high PE means high growth hopes. A low PE may signal risk or undervaluation. Understanding this difference is what separates smart investors from the rest.